Good morning everyone and welcome to this edition of Morning Markets here at True Potential. Now, as you'll see on screen, it was a weaker day for equities again on Friday. Why is this? Well, equity markets are continuing to adjust to much weaker forecasts for economic growth for next year following the central bank meetings from both the US Federal Reserve and the European Central Bank. Now, within both of those meetings, there were refreshed projections for the economic outlook over the next 2 years, but it's next year's forecasts which were dominating the post-meeting narrative. Both central banks, as a coincidence, now expect growth in each economy to slow to 0.5 percentage points. Now that's still positive, but it's sufficiently near zero that it's giving some market participants worries that we may have some recessionary-like outcomes towards the back end of next year. And in particular, following the European Central Bank, what's most worrying investors there is that for the first time in the European Central Bank's history, that's about 25 years, the bank no longer sees inflation at or below target at any point over the 3-year forecast horizon. And that gives markets very little optimism in the short run that the central bank will be able to cut rates towards the back end of next year, but will be forced to continue to hike rates at the current pace of 0.5 percentage points for every meeting. And that's roughly the narrative that our CIO, Jeff Casson, spoke with you about on Friday. Now, to put this into context, we're actually now seeing some real-time economic indicators from business surveys which corroborate this worry of slowing economic activity. In the UK, on Friday we had the retail sales data for the month of November, and unfortunately there was no optimism there of a bounce in economic activity through the November sales. In fact, we saw another decline year on year, and if you strip out the effects of spending at the petrol pumps, then what we actually have is quite substantial declines in spending because of the inflation component. Consumers are still spending the same amount of money, but it's going and spread over less goods, and that's pulling down this year-on-year measure for retail sales. Elsewhere, we had real-time indicators for business intentions for the months ahead from both the US and UK for the services industry. Now, whilst there are some really positive measures within there, particularly around input price inflation, that is, these businesses are seeing inflation rollover for their goods that they purchase to then pass through their business chains. We're also seeing delivery times as a result of COVID disruptions begin to fall substantially. This is really indicating that the very last remnants of the COVID supply chain disruptions are now behind us, and that delivery times, supply chains are now back to normal. However, on the weaker side, and for the first time since the COVID wave almost 3 years ago, we're seeing much weaker employment intentions in both the UK and the US. The UK measure was actually the weakest now for 2 years, and it suggests that sometime early in the new year, we may see parts of the services industry in the UK have very little employment growth whatsoever. In the US, it's a slightly different picture, where there are still hiring intentions, but where employees choose to leave, employers are not replacing those workers, and there's also some stories coming out of layoffs in other more exposed and cyclical industries. So definitely the beginnings of a narrative of weaker employment growth that will take us through into next year. Now, through today, we have very little data in the calendar as we approach Christmas, but please join us tomorrow where colleagues will update you on European wage growth and some US data on the housing market there. Thank you.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.